In today's video, I'm going to be really looking at if there will be a massive market crash and recession coming very soon. Obviously, we're hearing from the U.S. Federal Chair, Jerome Powell, that of course they're going to be raising interest rates until inflation comes down. And of course, we're also seeing that in Canada as well. So I've got a couple of different charts that we can look at that can really compare what's happened in the past when interest rates went to insane levels and what the stock market did. Also, some of my own thoughts as well. Okay, so this first chart is, of course, starting back in May of 1954 and ending in where it is today. These dark lines right here are all recessions or economic issues that brought the market down. So some of the things that we do see here when we start scrolling along is, of course, back in between this whole time, of course, this is inflation adjusted. In August of 1982 was roughly the bottom, and the worst the market's been over the amount of time that we're looking at from 52 to 2022. So what happened during that time in 1982? In 1982, they were just starting to come back down from the all-time highs of interest rates, which were well over 20%. Will we get back to these levels? That's the question that a lot of people are starting to ask. Historically, we don't see interest rates going very high above 6% very often. They usually also take many years to even reach that amount from past histories. As we can see here, it's taken 10 years. So if we look back to 1960 to 1970, what can we take from this? So 1960, inflation adjusted, the stock market went from 5,800 to 5,600. There was a little bit of a jump there. But between those 2 years, obviously 10 years in between, while interest rates were rising, the stock market sort of did that as well. Now, if we look between 1980 and, of course, the dot-com bubble right here to 2000, we see that the interest rates went from that insane level to a very low, as we can keep on moving along, 4.75%. So what was happening here was there was money getting removed and moved out of bonds and put into stocks. See, what happens is when interest rates are this high, people will want to keep their cash and just make interest off of it. Because if you're looking at 20-something% or even 18 or 15% annualized returns on your cash, why would you keep that money in the stock market if the stock market, for example, may only go up on average 8% a year and you may get, let's say, a 3 or 4% dividend? You're only looking at 10 or 11%. And if the stock, or if the dividend, or I'm getting confused now, if the interest is giving you 15, 18, 20%, guess what? It's a lot safer to hold cash and get a ton of interest than to have it on the stock market where it could be lost and have, of course, maybe a 2 or 3% dividend and 8% growth on average. So because of this, if interest rates continue to rise, if they go past that magical 5 or 6%, that's when you're going to see a lot of people moving out of dividend stocks, moving out of the stock market in general and going into just holding cash. As long as the interest rates are above inflation, that's what's going to happen. Will it get to that point? Well, let's take a world outlook. There's currently wars happening with major countries around the world. Of course, Russia being one of them. Of course, the Middle East is always going to be doing its thing. That's not going to change anything, the Middle East. They're basically a desert. So if we look at Russia and Ukraine, how long can that war last? How long are we going to be mad at Russia? How long are we going to be trying to prop up Ukraine and spending a lot of taxpayer dollars to do so? How long is this all going to last? That's a major question that I would be asking myself when I'm looking to invest. Obviously, I've got some cash on hand. I'm kind of waiting to see where the market's going right now. I'm trying to get into a bigger house and a bigger property. So I will need that cash pretty soon, potentially. So right now, I would definitely be holding on. If you've got the ability to hold on to at least 3 or 6 months worth of cash, I would do that right now. Because at this point in time, we don't know where inflation is going to go. A major push for this inflation is oil prices. We've seen gasoline prices here in Canada go up to $2.08, $2.18, which is crazy. It's costing me for 50 liters to fill up my Mustang, it's costing me over $110 to do so. And that's only getting me a little under 400 kilometers. That's crazy. That car used to cost me like 60 or 70 bucks to fill up. And now it's costing me almost double, which is crazy. So, what are the governments doing for us? Will these oil prices and gas prices go down so that inflation slows? They keep on trying to raise interest rates, but in reality, that's not going to help. Because even though you're raising interest rates, it's the gasoline, in my opinion, that's actually pushing this inflation right now. And the news can say, yeah, sure, it's Russia's fault, but really, it's our government's fault because we should be mining the oil that our countries have a lot more often. We need to be mining that oil as much as possible. If we don't, this inflation is going to continue because bringing oil over from the Middle East is going to be still extremely expensive. Obviously, you're burning fuel to bring fuel over. And then, on top of it all, we have more oil between Canada and the United States than any single country around the world. And we're not mining it as much as we should. We have the American administrations who are cutting back on abilities to mine. We have the Canadian governments doing the exact same thing and canceling pipelines. We don't see an exit plan right now from these high prices. We do probably need some kind of a government agency to come in and say, hey, we need to open up the oil fields. If they were to do that tomorrow, I can guarantee you the oil prices would plummet. And if the oil prices plummet, your fruits and vegetables that are being shipped in from gasoline vehicles and oil and any transportation burns diesel, oil, and fuel and anything, right? So because the high prices of shipping in general, that's going to be pushing the prices of everything else. That is the reason behind inflation. So right now, I would be leaning away from investing in oil companies. Technically, if you are looking at a quick trade, maybe it's a good idea. But if you're looking for a long-term investment, I would be staying away from oil companies. Because if the governments became smart and they turned around and said, we're going to open up the oil fields and we're going to let anyone mine, that's going to plummet oil prices like there is no tomorrow. You would probably see a 50% decrease in oil prices tomorrow if the governments came out and said, we're going to be opening up all warrants, we're going to be allowing all of this government land to be mined again, and everything's going to be fine. When will this happen, though? Well, the Biden administration is not going to open it, and the Trudeau administration is not going to be opening it either. So maybe in January we might have an election in Canada, potentially. We don't know. Hopefully it happens. And if the Conservative Party wins, then at that point, the Canadian oil fields may open and we may start getting these oil pipelines made. But there's still that major but, because at that point, sure, we can mine, but we would still be in Canada in the same situation we were in 10 years ago, where we just cannot sell the oil because when we're mining the oil, we have nowhere to put it. We have rail, we have a few pipelines, we have some pretty major pipelines. But we were shipping oil by train just because there wasn't enough capacity in the pipelines. So we need to build pipelines, but that takes a heck of a long time. You're probably looking at least 4 or 5 years before pipelines, any major serious pipelines, can be made. So we're now looking at potentially 4 or 5 years if Canada opens up their mining operations at full capacity. And then you would be also looking at the United States. And there's still, I think, 2 years or maybe 2.5 years left of this administration, and then there's going to be an election. So we would still be looking at another 2 or 3, potentially another 4 or 5 years on top of that, so 6 or 7 years, before inflation starts coming back down. This can be good if you invest the right way, but this just means that interest rates are going to be probably going up for the next 5 or 6 years if nothing changes when it comes to oil. This is why, right now, I would be leaning away from anything but bank stocks because bank stocks do extremely well when interest rates go up. That's just how it works. And now that we've seen that when there's tough times with banks, they still make a killing. So right now I am favoring still the bank stocks. I've been like that my entire investing life. But if we don't see something happening in the oil fields to open them up and get pipelines built, then we're going to continue to see inflation happening, and we're going to be going back to the 1980s where we were having 20% interest. Your house price is going to be plummeting, and it may just allow me to get into a house anyways, or at least a house that I want. Build my own indoor basketball court for my basketball training business. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.